Okay, we are back after our fire alarm. So we left off. We were calculating what the 5 payments were going to be because we already know what the fair value of the lease equipment is. So we're trying to figure out what the payments are going to be every year. So on a 10% yield, 100,000 divided by the present value of the annuity, which comes off the table. That's how they came up to the 23,981.
Oh, look at that. But
This, remember when you did intermediate accounting 2, that you did present value and future value,
Oh,
and you
the
use them to
table-
go to those tables? So you go to the table for a present value of an annuity due for 1 at 5 years at 10%, and it gives you that number. Okay? So in our problem that we were just discussing, the lease meets the criteria for classification as a direct financing lease for several reasons. And these are the reasons why it's considered a direct financing lease. The lease term exceeds 75% of the equipment's estimated economic life. The present value of the minimum lease payments exceeds 90% of the equipment's fair value. Collectability of the payments is reasonably assured, and Caterpillar incurs no further cost. So these two right here are from group 2, and the top ones are from group 1, although they only needed one of the two. You don't need both. This is group 2, and this is group 1. Yes, both of those are from group 1. Okay? It is not a sales type lease because there is no difference between the fair value of the loader and Caterpillar's cost. So that's how you know when there's a sales type lease, that there's an actual profit. There is a profit because your fair value is greater than the cost, then it's a sales type lease. So that's how you have to ask yourself. So there's 2 steps. Step 1 is to determine, does it meet these criteria? If the answer is yes, then it's going to be either a direct financing or a sales type lease. If it's not, then it automatically reverts to operating. If the answer is yes, it meets these criteria, then you determine, is it direct financing or is it sales type? How do you determine the two? Sales type is if there is a profit. If there's no profit, it's automatically a direct financing. How do you determine if you have a profit? You look at the difference between the fair value and the cost. Okay? And we'll do an example on sales type. So, computation of the lease receivable. Total payment, 25,981, which we had from our problem, minus the 2,000 of the executory cost. Your payment is a 23,981 times the present value of the 4.16986 gives you 100,000. Caterpillar records the lease of the asset and resulting receivable on January 1st as follows. So in this case, it's a debit to your lease receivable because you're going to collect 100,000 from the lessee, and you're going to credit equipment of 100,000. That means you're taking this equipment off the balance sheet because technically, it's the ownership's going to the lessee. So back to our lease amortization schedule, it's the same concept that we did on the lessee side. You have your 100,000. You have your payment, you back out your executory cost, you have your lease receivable recovery, your principal balance times a 10% interest, same concept on the lessor side. So you see how there's the matching principle? What you do on one side on the lessee is what you do on the other side for the lessor. That is what GAAP tries to always achieve, but there's a matching principle.
Let me see if I understand what the first 23,090.
This number came from this minus this, which was given to us in our problem.
On the first year is 0%.
Correct.
But
Yeah, same from before.
Okay. Now,
So because there is no interest, the entire payment gets applied to principal.
Okay, now you raise 23,900 from 100.
The 23 from 100, correct.
And he's 76.
That's correct.
And the 10% of 76, 7.
601.
601. 23 minus 7 is 16.
Mhm.
No, the 76 minus 16 is 59. Yeah, okay.
So again, same thing that we did on the lessee side, you're doing on the lessor side. But now, however, on this case, it's lease receivable, interest income. On the lessee side, you have interest payable or interest expense and lease payable. So this is just going to now go into the journal entries, which is exactly what we did on the lessee side. On January 1st, 17, Caterpillar records receipt of the first year payment. So on January 1st, we get our first payment of $25,981. So we debit cash, and we're going to credit our lease receivable by $23,981, and the other $2,000 goes to property tax expense or property tax payable. Exactly, it's the inverse of what you did on the lessee side. Interest revenue, so now we have to do the accrual for the interest revenue. So we're going to debit interest receivable and credit interest revenue, 7601. This is just a presentation of what it's going to look like on your balance sheet. And now the payment on January 1st. So you're going to debit cash, you're going to credit lease receivable by the principal amount, and you're going to credit your interest receivable by the amount you accrued the year before. So same thing, but inverse. On December 31st, 2018, Caterpillar accrues interest as follows. So it's just so on and so on. So now we go to the operating method. In this case, inversed. You're going to debit cash, credit rental income. Mm-hmm. So you see, debit cash, credit, in this case, they call it rental revenue. And your depreciation expense, you're going to record your depreciation because you, the lessor, are the owner of the asset. So you take the depreciation for it. Okay? So that was accounting for the lessors. So quick recap. On the lessee side, you have capital or operating. On the lessor side, you have direct financing, sales type, and operating. Those are the three. We learn how to do the accounting for both of them. So the last section, we're going to talk about accounting and reporting for special features of lease arrangement. So this is going to be like special items that take place in certain leases. These are the 6 sections we're going to talk about in this section, starting with the residual values. Then we're going to jump into sales type leases, which we didn't do when we were doing the lessor side. We didn't do sales type leases, so we'll do that. We'll talk a little bit about bargain purchase options, initial direct costs, and current versus non-current classification and disclosure is the last thing. So, residual value. The meaning of residual value is the estimated fair value of the lease asset at the end of the lease term. So when your lease is up, you come up with an amount of what you think that asset's going to be worth. So you can have a $50,000 cost and say at the end of the lease, I expect this to be worth $5,000, just like a car. Okay? If you go to trade it in, it's going to have a value, but that's the residual value. Guaranteed versus unguaranteed. So a guaranteed residual value is when the lessee agrees to make up any deficiency below a stated amount that the lessor realizes in residual value at the end of the lease term. So in this case, the lessor is going to tell the lessee, at the end of your lease, I want you to guarantee $5,000. That's what's considered guaranteed. So the lessee will have to give that $5,000 to the lessor.
The warranty, like they return the equipment in good condition or something?
And they're guaranteeing you that they're going to pay you the residual value. They're going to pay you what the residual value is worth. Unguaranteed is that they're not going to pay it to you. And you'll see.
For example, in the car lease, you got 10,000 miles a year. No?
Mm-hmm.
If you pass that,
Mine have 12.
Oh, well, okay, good. Okay. You pass in 3 years 36,000 miles, you have to pay the lessor some amount.
Correct.
Like
So, lease payments. Lessor So notice here it says, lessor may adjust your lease payments because of the increased certainty of a recovery of guaranteed residual value. So they will incorporate that amount that you're going to pay in your lease payments. They'll include it in there. So you don't have to make one payment at the end. Lease accounting for residual value. The minimum lease payment includes a guaranteed residual value, but excludes an unguaranteed residual value. So now when we start doing the accounting, when we go back, you're gonna see that if it's guaranteed, you have to take the present value of the minimum lease payment. So back to our problem, but now there is a change because we're gonna now incorporate residual value. So if you recall, our original problem had zero residual value. Here it has 5,000. So we're gonna come here.
That's why when you don't finish a lease and you want to change your car, they add
The residual value.
the residual value
Yep.
next.
Correct. Because in auto leases, you're guaranteeing that residual value. You don't have an option. You have to guarantee it. I'm just trying to see if anything else has changed.
I imagine how much you're going to cost.
Okay, so the only thing that changed in our problem is just now the residual value of 5,000.
All thousand million?
No.
120,000.
Depends. More or less, yeah, but more or less, 30 something, no?
I don't know the new.
Yeah,
So
more
I
or less.
don't know, because I like the SUV.
Oh, la puerta se abre como.
Yeah, I know.
Yo vi more or less, yeah.
I like SUV cars. I
The
don't like
basic,
small
the
ones.
basic cuesta 75%. The basic.
Okay, so if you recall, when we did the problem prior to there being a residual value, remember this was always zero? When we did the problems before, so now we have a residual value. So what does it tell you to do? It tells you to take the present value of the residual value and subtract it from your lease payment. So you take $100,000 minus the present value of your residual value, 5,000. This comes off your present value table. So 96,895, you're gonna take that 96,895 and divide it by the 4.1, which we recall from before we were using. So now your new payments are 23,237. These are the new payments.
All those values are in the table.
So all those come out of the table, correct. But in the homework and in the test, they'll give it to you. You won't need to go to those tables. So computation of least capitalized amount, assuming a guaranteed residual value. So now you have here your present value of your actual payments and your present value of the residual. The sum of those two equals the amount capitalized, the 100,000. See how they got to that? They just broke out the two components. Now we go back to our amortization schedule, but our amounts have now changed. So now our lease payments, we calculated that lease payment in the slide before of 25,237. I'm just gonna go right back to that slide so you can see where the number came from. Oh, there you go. All because of the 2,000, that's why, because they're backing out in the original calculation, they didn't have the 2,000. So there's your 23,237. See that? It's because of the 2,000 executory cost. So we start with the same thing we did for all the other ones.
The only one that changes the end
Is
like
the amount, is the lease payment amount. That's what changed.
no, the payment amount continues exactly until the end of change.
Watch. So right here we have 25,237. And I don't want to pull it up. I have the slides here. Easier for me to show it to you here. So on the prior slides, we were using the 25,281 and 981 because our problem, remember our problem gave us that?
Mm-hmm.
That was the amount we had in this column here.
Oh, okay.
What makes this different now? That we calculated what the payments needed to be because we backed out the residual value. In our other problem, there was no residual value, so we didn't need to do this. So we figured out what the payment is supposed to be of 23,237, 5 payments. Because you need 5 payments to get to this 96,895. Now watch. But we need to include the executory cost in our payments. That's why they added the 2,000 there. That's why it's at 25. You take the 25 minus the 2, that's your payment that we calculated. Okay? And you do the same calculation on your amortization schedule. Now, notice at the end, the only difference at the end is your 5,000 of residual. And look how they broke it up between interest and reduction of lease liability, leaving your lease liability down to 0. This 454, 10% of this, that's how we came up to the interest. The remaining amount was applied to the lease liability, and you're down to 0. The difference between this and the problem we had done before is that now our payments are greater because we needed to include the residual value because it was guaranteed. So the lessee guaranteed that they were going to pay that residual value. So this is just for presentation purposes. So down here it says, assume that Sterling, who's the lessee, depreciated the lease asset down to its residual value of $5,000, but that the fair market value of the residual value of December 31st was $3,000. Sterling would make the following journal entry. So as you can see in this situation, the residual value is 5, but the fair market value is 3, so there's a $2,000 loss. So you're going to debit loss on capital lease. You're going to debit your interest expense for the last little piece of that 454 we saw. The remaining amount due to pay the lease liability down to 0. We are going to record the 95,000, the reversal of the accumulated depreciation of 95,000, and you're going to remove your asset off the books, your leased equipment of 100,000. So this is the entry that takes place on the last year. Your loss, this goes down to 0. You're reversing your accumulated depreciation and you're reversing your asset off the books. The last year your lease is done.
That's how you close everything with the lease.
The last entry.
The reversal is you read the 5,000 from the 100 on the 100.
So since you remember when you do depreciation, go back to your basic accounting. When you do depreciation, you take the cost minus your residual value. That's what you depreciate. That's why you only depreciated 95,000. The remaining is your
take
residual.
all the 5,000 that the residual value. And your cash of 2,000.
So now we do unguaranteed. So what happens if they don't guarantee it? In this case, you use a 0 here for your residual value calculation because they're not guaranteeing it. So your payments stay the same, 96,895.40. So now your capitalized amount, notice your capitalized amount now is not 100 like it was before. So we're on our amortization schedule. We're not starting with 100. We're starting with 96,895. See? That's your liability. Because they're not guaranteeing you the residual value, you're not getting paid that amount. So you can't put it as a as a receivable.
So you reduce the 5,000 at the beginning, correct? Instead of at the end.
At its present value. Remember we took the 5,000 with the present value factor and we came up to that $3,000 number?
That's the number that you take out of the home.
You gotta do it at the present value.
Yeah, another 5,000. You have to calculate the 5,000 time or
It was time.
Time.
It was time.
The
So the
value of the
factor.
table, no?
Mm-hmm. Correct.
Amount is that you.
Correct. Because remember, you want to know what that $5,000 is worth today, the present value today, even though it's something that's going to take place in 5 years. That's why you do that calculation. So all this is basically just showing you is that now there's a difference here. So at the end, Your total reduction of lease liability is the 96 you started with. And the interest, again, stays the same. It's always 10% of the outstanding principal amount.
And here it is different cost.
Exactly. So look at our annual lease payments. Before it was 131, now it's 126. So these slides are just showing you the difference between, it's going back to the first couple slides when we were doing the lessee side, but when we did our initial problem, there was zero residual value. Here's just telling you if you do have a residual value, guaranteed versus unguaranteed, and how to account for it on your books and records.
Okay. Never seen the possibility, like, for example, say, like, the value is 100,000. I'm going to do a list for 5 years. You divide that total between 5, and it's like, how much you're going to pay per year?
No, because you have to include interest. Correct. And the way, but you can do your own accounting, but if you're getting audited financial statement, GAAP requires you to do it this way to calculate the present value for your minimum payments. So in your case, you would do it more on a cash basis, what you're doing versus an accrual. Okay?
The method.
Correct. So GAAP requires you to do this whole calculation.
I'm just asking. I never saw someone do it, but I just.
And in this case, at the end of the lease term, for unguaranteed residual value, all you're basically doing is your leased equipment less accumulated depreciation, nets to zero, and your lease liability is zero. So this slide is just showing you the different entries that take place throughout the years on guaranteed versus unguaranteed. So this is a pretty important, and it helps you understand just the difference between one and the other. And the main difference, as I had mentioned, is at the beginning, whether you're going to record 100,000 lease liability or the 96,895. Because again, in this situation, you're going to collect the residual value, and in this scenario, you're not. Okay?
Like the first payment will change.
No, the payments don't change. No.
Oh,
Now, what does change is your interest changes. Why? Because your principal balance is different. Because since you're starting with a different amount, your principal balance is different. Okay? But your payments don't change. So that was the lessee side of it. Now on the lessor side for residual value, the lessor works on the assumption that it will realize the residual value at the end of the lease term, whether guaranteed or not. So for the lessor, it doesn't matter if it's guaranteed or not. They always assume they're going to recognize the residual value. Okay? So you'll always use the first method that we did. Okay?
So you're always going to do residual value for.
Regardless whether it's guaranteed or not for the lessor.
Okay.
So on the lessee side, if it's guaranteed, you do one method. If it's unguaranteed, it's a different method.
Si tú eres el que vas a.
Siempre uso.
And if you recall from when we did it on the lessee side and it was guaranteed, it's the same schedule. Okay?
We're going to have exercise like if we are the lessor and if we are the lease.
Yes, the bond will tell you who you're recording the accounting for. So these are just journal entries on the lessor side. Lessor.
Lessor? How do you pronounce it?
Lessor.
Lessor?
Because I have an O in the end.
Lessee.
Lessor es el dueño.
No sé. Pero la pronunciación a veces me enreda también.
Okay, so the last time we were missing was the sales type leases on the lessor side because we did direct financing and we did operating. So the primary difference between direct financing lease and a sales type lease is the profit, as I had mentioned before. The lessor reports the sales price of the asset, the cost of goods sold, and the related inventory reduction and the lease receivable. There is a difference in accounting for guaranteed and unguaranteed residual values. So these type of leases for the lessor, there is a difference in accounting. So don't get confused. We just said there wasn't for the lessor, right? That was on direct financing. It's telling you here for sales type, there is.
So, the difference is
To do like a canto gallego.
the lessor, the difference is the guarantee and non-guarantee.
So, the best way to, I would say, to study for all this is just jot down on a piece of paper, all the different rules there are, and just memorize them. Because you have to ask yourself, when you get a problem, you have to go through all these different questions to know what to do. You're gonna see now how we record these type of transactions. Actually, this is illustrating the difference between a direct financing lease and a sales type lease. So, equals fair value, so your fair value and your cost are the same. So you bought an asset for 100,000, it's worth 100,000, it's a direct financing lease. The whole time it's interest revenue. Your total payments, interest and principal, interest revenue. In a sales type lease, it's not. Your fair value and your costs are different. The net of those two amounts is your gross profit. Then the rest goes on as interest and principal payments. So lease receivable, also referred to as net investment, is the present value of the minimum lease payments plus the present value of any guaranteed residual value. So it's basically telling you, if you have a sales type lease, right, your lease receivable is going to be the present value of your minimum lease payments plus the present value of any unguaranteed residual value. The sum of those two is how you calculate your lease receivable, okay? Sales price of the asset is the present value of your minimum lease payments, and cost of goods is the cost of the asset to the lessor. So you're gonna come up with your sales price less your cost of goods, that's going to be your profit. And your sales price is what? The present value of the minimum lease payments, and your cost of goods is the cost of the asset, less the present value of any unguaranteed residual value. So that's important to understand.
This chapter going to the exam?
Yes. So let's do our example. We're getting to the end already.
50 question book to the exam. 3 hours.
It's a lot of information, you just have to memorize it. Okay, so let's. So. Imagine memorizing all the stuff for the CPA exam.
No, I was good on memorizing stuff, but the good is sometimes I have so much like
Information in your mind that you can't
so
memorize,
much-
there's no more space.
no worry for work and
Yeah.
personal and everything that don't let you like, record.
Okay, so in this case, it's guaranteed residual value and with an unguaranteed residual value. Assume the same fact as the preceding direct leasing situation. The estimated value is 5,000, the present value of which is 3,104. So it's telling us that our residual value is 5,000. Its present value, which we already had calculated before, is 3,104.60. The cost of the equipment is 85,000. Why is that important? Because we need that for our sales minus our cost of goods sold. And it's assumed that the fair market value and the residual value is 3,000 at the end. So the fair market value of the residual value, 3,000. I've always been good, and even when I did my CPA exam, when I would get these big complex problems, I would always jot down all the facts like that. So it made it easier for me to understand what they were asking for. That's why I'm so used to always doing it this way. So, remember I told you there is a difference in guaranteed versus unguaranteed in this scenario? So here's the difference. Your lease receivable, in this case, stays the same, 100,000. Your sales price of the asset, if it's guaranteed, is just your regular 100,000 and 85, your cost of goods of 85 for a $15,000 profit. If it's unguaranteed, all you need to do is subtract the present value of your residual value from your sales price and from your cost of goods. But at the end of the day, your gross profit will still be the same. It's just the way you account for it on your income statement. So that's the only difference.
If it's different, how at the end of the day, it's an amount.
It's just presentation.
Oh.
It's for presentation purposes.
And the real world part.
No, in the real world, you usually do guaranteed residual value. Usually you don't really see a lot of unguaranteed residual values. So once again, just the journal entries and the differences between one versus the other. Look up here. The cost of goods includes your residual value here. Subtraction of your present value of residual.
That's how we're going to compute, our exercises, like, for a year, like that.
Your exercises aren't going to be this complex. Don't worry, they're not going to be this complicated. Okay? Your exercises are going to be more focused on accounting for lessors and accounting for lessees. There's not going to really go much into these special type of items. We've already spoken about bargain purchase option. Initial direct cost is only a component on the lessor side. It basically says that if there's any initial direct cost, which means as you're negotiating the lease agreement, let's just say you pay an attorney to help you negotiate that, that is what's called an initial direct cost. And for each type of accounting method, it tells you how to record the initial direct cost. So for operating leases, it says you should defer the initial direct cost. So you defer it to the future. Sales type lease, the lessor expenses it right away. Direct financing, they include it in the net investment. So that's all this slide is telling you. This is just facts for you to know. Okay? And the last slide is disclosing. So this is basically when you have a lease on financial statements, what information gets disclosed on your financial statements. And on the notes section, there's usually going to be a description of the nature of the leasing arrangement, the nature, timing, and amount of cash inflows and outflows associated with the lease, including payments to be paid or received for each of the 5 succeeding years. So remember that, it's 5 years. That's the most you have to put on your statements. You don't have to go further. So if it's a 10-year lease, you only have to put 5 years worth of information. So the amortization schedule only needs to be 5 years. The amount of lease revenues, expenses reported in the income statement each period, descriptions and amounts of leased assets by major balance sheet classification and related liabilities. So this basically means if you lease 10 different pieces of equipment, you group them by what kind of equipment it is. So it could be furniture, it could be vehicles, you combine them all. And amounts receivable and under revenues under lease agreements. And that is it.
Thank you, Professor.
I know it's